is I'm going to get into the definition of the derivatives. And the reason why they're really important is because they're used. And trillions of dollars of derivative contracts that are based on these underlying indices and these underlying commodity prices trade in multi-trillions of dollars per day, 24 hours a day. So it's a huge market, and you got to understand it. And I think what's really interesting is if you understand derivatives and you understand derivative trading logic, you can apply it to other areas of your career, because it basically trains you in logic and mechanistic decision making and knowing that you're making the right decisions. Because if this happened, then you do this, this, and this. That's it. And it's the right decision to make. So these derivative securities, these derivatives, which have become extremely popular, they were invented in the 70s. They became very popular in the 80s and 90s. And in the 2000s period, basically the investment banks and the other banks manufactured these securities, created multi-trillion dollars of contingent liabilities off balance sheet of the financial institutions, and when the whole system collapsed and blew up, it was the derivative contracts that were basically the tools in which Wall Street took down the system, okay? And it was the Federal Reserve Bank and the Treasury and other financial institutions that basically went in and bought these securities and bailed out the system and kept the economy from going into a depression, okay? So it's not, in my view, it's not the derivatives themselves that took down the system, it was the corruption of Wall Street and the illegality that they basically pushed. They used these tools to basically rip people off. But they are valid tools and they work. And when the system works right, they're extremely valuable, and you have to use them. So the derivatives are based on asset price movements, the 5 asset classes. They're based on indices, which are basically mathematical calculations. Standard & Poor's basically manufactures and publishes the majority of indices tracking those asset classes. It is the premier index calculator, okay? And I actually worked with S&P to build the first series of transaction-based, price-based real estate indices. And then we were developing the derivative contracts. We were doing all of this stuff for the first time in real estate history on real estate price indexes, okay, and developing these markets. And if you're interested, I will go through that process. If you want to hear about the process of developing the indices and developing the derivative markets. And then I'll give you the closing chapter on that, because when the financial crisis hit, they discontinued the indices, and we do not have these products in real estate. Okay, we do in equity, we do in fixed income, we do for commodities and the other large asset classes. There are no derivatives and no price indices for commercial real estate. My indices were cut, were killed. Okay, it's based on indices. It's based on prices. Okay, and it's based on movements in other security prices. So over here, you had option contracts that were being traded on the prices of futures contracts, and the futures contract prices were being derived by movements in the price indices. So that's why they're called derivatives. They're not the underlying stock and bond. It's a security traded on the price of other stocks and bonds. So it could be derivative of derivative of derivatives. Okay. Forward contracts and futures contracts, very similar to each other, but very different. The forward contract and the futures contract, you would buy the contract if you think that the price is going to go up. Okay? You are going to write the forward and futures contracts if you think the prices are going to go down. The option contracts, you are going to buy call options when you think the prices are going to go up. You are going to write put options when you think the prices are going to go up. You are going to write call options when you think the prices are going to go down. And you are going to buy put options when you think the prices are going to go down. So as you can see, it's very logical. Okay, it's binary. How do you make money? What are futures and forward contracts? Forward contracts basically state that I enter a contract today. for a forward price in the future. So I'm going to enter a contract to buy oil at $50 a barrel. If the price of the barrel of oil goes to 100, in a year from now, I'm going to exercise that forward contract. I will be able to buy oil at $50 a barrel and sell it at 100. That's the contract. Forward contracts are forward-looking. They go very far out into the future. They could be a year, 2 years, 3 years, 5 years. So I'm entering into the contract, into a long-dated contract that settles at the end of the period, okay? And I don't have to put any money out during the time period, only at the end of the contract period. The forward contracts are custom contracts, okay? They are between two counterparties, two investment banks, two multinational corporations, a money center bank, and a multinational corporation. So it's two counterparties. And the forward contract is basically written up by a securities attorney and signed by the two counterparties. And the investment banks could be the advisor that brings the two parties together, negotiates the forward contract along with the securities attorney. Once the contract is in place and negotiated, it will then be signed, and the two counterparties are bound to the contract. Okay? There's no intermediary. It's between the two counterparties. Since these are private contracts between the two counterparties, they are what are called traded in the over-the-counter market, or the OTC. It's very opaque. We don't know about the market. We don't know about the contracts. We don't know how much liquidity or marketability of these contracts are. We don't know a lot about it, okay? Because they're not traded on an exchange. They settle at the end of the period. They are negotiated, and the notional values, the size of these things, are very large. They're probably in the hundreds of millions or billions of dollars is the contracts. So you have to be a very large financial institution or multinational corporation to enter into these forward contracts. The futures contracts are basically similar to the forward contracts, but there's different types of product attributes or characteristics that make it unique. One is the futures contracts are exchange-based. They're developed by and traded by or on major commodity exchanges, okay? The two major exchanges, other than Hong Kong and London, is the Chicago Mercantile Exchange out of Chicago and the Chicago Board of Trade, the CBOT. That's where these derivatives are futures contracts and futures on option contracts are traded. These are standardized contracts, so they're not custom, they're standardized. They have small notional values, and they're highly liquid, and they're highly marketable, unlike the forward contracts. So we have lots of broker-dealers, we have lots of traders that are in trading these securities. And these securities are basically geared towards small to mid-sized companies that can't access the forward market, that want to be able to gain exposure or hedge off market risk that they may be subjected to on their balance sheet or to their income statement. Okay? So the futures contracts, here's the example of the futures contract. You're going to enter into a forward-dated contract, okay? But the difference is when you enter this contract, you have to put up money as collateral to a broker-dealer for the exchange, okay? So the exchange is an intermediary, and you got to put up money. And you have to have experience in trading futures contracts. Nobody can just do it, okay? So you have to be specialized, you have to have experience, and you have to have capital to be able to back you, and you have to have credit if something was to go against you. So you're entering into a forward-dated contract. I think that prices are going to rise, over the next 6 to 9 months for oil. I enter a contract to basically buy oil at 50, and if it goes to 100, I'm gonna make the difference. But what happens is, let's say to get to 100, there's volatility, in the oil prices, and if the oil prices are above, what my contract price is, I'm going to get the money and I'm going to put it in my pocket that day when it settles. If the price is below the contract price, then they're going to take money out of my account. So the futures contracts are settled on a daily basis, where the forward contracts settle at the end of the period. So if you have a futures trade that is going negative against you, you're paying out money, the brokerage firm will give you a call and say you have to put up more margin, you have to put up more capital, or you need to unwind your trade. Either you put the money up or you unwind it, okay? And the beauty of the futures contracts is, let's say you take a long futures position, you think prices are gonna go up, but prices are going down, right? So you bought a futures contract, that's all you have to do is write a futures contract and negate the position, okay? You take the opposite position and to cancel out the trade. So if I'm going long, I think prices are going up, so I bought this futures contract, and all of a sudden prices are going down, I can write a contract, offset the long position, and cancel the trade. So the futures contracts are highly liquid because people are entering into these contracts. They're writing and buying the contracts based on their position, and if the trades go against them, they just take the opposite position. If I go long and prices are going down, I write a contract, cancel out the position. If I think prices are going down, I'm going to write a contract, but if they start going up, I'm going to buy a contract, cancel out the position before I lose too much money. So there's a lot of trading volume that occurs in these futures contracts. Now the options contracts on the futures contracts, you're not settling every day. You're not settling every day. Let me talk about the options, and then I'll talk about the options on the futures, because it'll probably make more sense. So the options contracts are different than the futures and the forward contracts. Let's say I think that prices are going to go down, all right? So I'm going to buy a put option. But to buy that put option, I gotta pay a premium. So I gotta pay to buy that position. My view that things are going to go down. So money is coming out right off the bat. I think prices are going to drop, and I want to bet on that. So I'm going to pay a premium right off the bat to pay for that put option. So I need the price of the option, the price of the index, or the price of the stock to drop a certain amount to pay me back for the premium that I paid. Once I get past the break even, it's all profit, okay? So on the put side, let's say I bought at 50, so I take that back. So I paid the premium, I have an exercise price of $50, okay? The price drops to 25, okay? I can exercise my put option at $50, so I just pocketed 50 bucks, right? Then I pay back the premium, which is, sorry about that, 50 to 25 is $25 profit. I paid a $10 premium, so I net $15. So it's the profit minus the premium that's going to give you the profit. And then in option contracts, each contract is for 100 shares, and in this case I bought 3 contracts, okay? So when I buy a put, the price has got to drop enough for me to get through break even. Once I get through break even, it's going to be the profit's going to be the difference between the exercise price and where the price went, minus the premium is going to give me the profit. The profit times the number of shares times the contracts is the total profit that I walk away with. So I can make money on falling prices. For the call options, it's similar. I think prices are going to go up. I buy a call option, got to pay a premium. Prices have to rise a certain amount for me to get paid back on the money that I put out for the premium. and then the prices continue to go, in this case to $100. Well, I can exercise that call option at $50, so I buy it at 50, and I can sell it at 100. So I basically made, in this case, what was the 50? Oh. My mouth is off. So I made $50 and $40 in profit times the 100 shares per contract. That's going to be the total profit that I get from that trade if stock prices, in this case, or oil, go up. Okay? So in this case, I am buying these contracts. So I have to put out the premium. If I think that that prices are going to go up, and I buy a call option, there's somebody else who thinks prices are going to go down. So those people write the call option, I buy the call option. They think they're going to go down, I think it's going to go up, they're willing to write the contract, I buy their contract. Okay? Same thing with the put. I think prices are going to go down, I'm going to buy a contract. There's somebody else that thinks that they're going to go up, they're going to write the contract, we get matched. If the prices do not rise enough under a call option, where the prices do not fall enough under the put option, then the premium is pocketed by the writer. The writer gets the money in their pocket instantaneously. So if these trades do never reach break even, the writer of the contracts keeps the money. The option contracts expires worthless. Okay? The writer gets to keep the money. These option contracts run in 3-month increments in a calendar quarter. So we're currently in the February period of the option contract period at the beginning. The options are going to expire at the end of March. So we basically have, what, like a month and a half left in this contract period. If I don't get past break even in any one of these within this time period, the options expire worthless and the writers get to keep the money. Then if I want to continue to bet on price movements, I can then buy on April 1st and the time period will run through the end of June. Then I can buy the 1st of July, run through the end of September, buy in the 1st of October, and run through the end of December. These are the 4 option contract periods. The value of these options are determined mainly by the volatility in the prices, one factor. The other is the time value within these quarterly periods. So the options are really expensive at the beginning of the period, and then the time value starts to degrade over time because the probability of them being in the money as they get closer and closer to expiration starts to degrade, starts to whittle away. Okay? So those are really, you know, the 2 derivative securities. And you can do these puts and calls. Instead of using stock prices, you can be using futures prices. So it's options on the futures contracts. These futures have prices to them that are based on the indexes. So you're not trading on the index prices, you're trading on the futures prices, and the options are on these prices. So you can just, these could be futures prices right here. So the reason why people use call options or put and call options on the futures as opposed to the futures is they don't have to put money out every single day. They can buy these contracts for these periods, they can pay the premium or receive the premium, and then they can also exercise these options at any time during this period. Okay? In Europe, you enter the contract here, it expires here, and then you settle, just like a forward contract. In America, you can enter into these option contracts, and you can exercise the options at any time during these periods. That makes the premiums more expensive, that makes the flexibility of the contract more valuable. Because all of a sudden, if I get in the money, I could exercise the option during this time period, and I could pocket the money. Okay. Any questions on the forwards and futures and options? I can go through them again later.
Can you explain the math again, just on the
Yeah.
put and call?
You put out the premiums.
Okay.
Okay, that's $10. It's a put option. I have an exercise price of $50. Stock price drops to 25. So basically the difference between here is $25. But I paid a premium of 10. So the $25 minus the 10 that I paid, the profit is going to be, or the amount that you're going to be in the money is $15. Okay? And each contract, we have 3 contracts. Each contract is for 100 shares. So that's the mechanics of the put. The mechanics of the call is the same thing. I enter a call option contract. I pay $10 premium to enter it. My exercise price is $50. The price of the stock goes up, breaks through the 50. Now I'm basically in the money. The difference between the current sales price and the exercise price, I can then exercise the option, the call option, exercise it at 50, sell it at 100. I basically am in the money by $50. Since I paid $10 for it, I subtract out the 10, which is $40, and then each contract is 100, multiply it, that's my profit. Does that make sense?
Mm-hmm.
Okay, good. So let's stop it right there.